This is where we take these really complex analyses, often very dense material, and distill it into the knowledge you really need.
And today you've brought us something that is, it's incredibly timely. A piece of research on Fubotv Inc., or ticker FUBO.
Right. And it's deeply contrarian because this company, well, it's been through the ringer. For years, the market's basically treated FUBO as a cautionary tale.
It's the classic, cash-burning SPAC stock. That's been the label.
Exactly. And that consensus view, that narrative, has driven the stock price way down to around the $2.52 range. And for most investors, a price like that just signals failure.
Or at best, it's a dead stock. You're just waiting for the inevitable to happen. Failure is, as you said, baked in.
And that baked-in narrative is exactly what this analysis is attacking head-on.
Right. The prevailing sentiment just assumes the company is, well, structurally broken, destined for perpetual losses. They think management is just delaying the end.
But the report we have in front of us, it doesn't just disagree. It calls that whole consensus a fundamental mistake. The title really frames our whole mission today. Everyone gave up on FUBO. Big mistake.
And the mistake, according to this analysis, is that investors are running for the exits right now, right at the bottom.
Just as the company supposedly hits a major inflection point.
Yes. The report argues the market is just obsessively focused on the stock's, historical collapse, the ugly chart. And in doing so, they are completely missing the fundamental business turnaround that's happening right now. They're calling it the profitability flywheel.
Okay, profitability flywheel. That's a powerful term, but buzzwords can, they can hide a lot of weakness.
Of course.
So let's unpack this. If the market is really making a huge mistake, we need to see the proof. The hard evidence in this report that the business model has truly turned a corner.
We have to. The entire bull case hinges on this. Because historically, the bear argument was simple. FUBO can't make money. They burn cash way faster than they earn it, mostly because of those really expensive sports content deals.
Okay, so let's tackle that cash burn story directly. What's the smoking gun evidence the report points to? The big pivot.
It really comes down to one critical number from their recent filings.
And what's that?
The data point that just completely contradicts that old critique is that in Q3 2025, and we have to stress, this is the most recently reported quarter FUBO hit positive adjusted EBITDA.
Positive how much?
$6.9 million.
Okay. $6.9 million in positive adjusted EBITDA. Let's pause there for a second because that term gets thrown around a lot. For anyone listening who doesn't live and breathe financial statements, what does that actually mean?
Right. It's basically earnings before interest, taxes, depreciation, and amortization.
Mm-hmm.
And in the streaming and tech world, it's sort of the standard proxy for the health of the core business.
So it strips out a lot of the accounting noise?
Exactly. And that $6.9 million matters so much because it proves, finally, that the company's revenue from subscriptions and ads is now enough to cover its core operational costs, including that very expensive sports content.
But a critic would immediately say, well, adjusted EBITDA isn't real cash flow. It can be massaged.
Yeah.
What does the report say about how they got there? Was it just, cutting everything to the bone?
That's the key question. And the report argues this turnaround is structural, not just superficial. This flywheel idea is built on two things.
Okay.
First, they've gotten way more efficient with their content deals. They're getting better terms. And second, and this is crucial, they're monetizing their users with high-margin advertising revenue, much, much better than anyone expected.
So the subscription money covers the cost of the content, and then the ad revenue, which is almost pure profit, that just falls straight to the bottom line.
That's the flywheel. More subscribers mean more ad views, which funds better operations, which then attracts more subscribers. It starts to feed on itself.
And if that wasn't enough to kill the bear narrative,
it gets better. The report highlights that this wasn't a fluke. Q3 2025 was the second consecutive quarter of positive adjusted EBITDA.
The second one, so it's a trend, not just a one-off lucky quarter.
It's a demonstrable trend. And that makes the years-long cash burn story, well, it's financially irrelevant now. But that old story is still what's being priced into the stock at $2.50.
It's just fascinating how market psychology works. People get so fixated on that long, depressing chart line, they don't even look at the recent financials. But if they pulled off this turnaround, how did they do it without alienating their customers? Usually margin improvement means big price hikes that send people running.
And that leads us right to the next key point, customer loyalty. The analysis notes that even though the company focused on cost discipline and, yes, raised its prices, subscribers didn't leave.
They stayed.
They stayed. In fact, North American subscribers hit a Q3 record of 1.63 million.
Wow. 1.63 million subscribers who stuck around even when it got more expensive. What does that tell you about the product itself?
It tells you the product is incredibly sticky. That's the term from the report. FUBO didn't try to be another generic Netflix. They focused intensely on that high-value sports fan.
The customer who really needs live sports and can't get it just anywhere.
Exactly. And by doing that, they've established real pricing power. Power that Wall Street is, according to this, completely underestimating. They're valuing these loyal sports fans like they're just browsing a generic video library.
And if you've proven you can keep customers while raising prices, that becomes a massive strategic asset, especially in a market that's consolidating.
That loyalty is the gold mine. And the report identifies what it calls the Disney Hulu factor as this huge external catalyst.
Meaning?
We're seeing all this news about Disney combining its assets, Hulu plus live TV and so on. It signals that the whole market for these internet-based TV providers, the vMVPDs, it's consolidating fast.
And when consolidation happens, the big players are looking for market share they can buy, not build.
Precisely. FUBO is now positioned as a prime M&A target for a Disney, a Comcast, maybe even an Amazon. It is so much cheaper to acquire 1.6 million loyal sports fans than it is to try and build that base from scratch.
So the market sees a dying cable company, but an acquirer sees a tech platform with recurring revenue and a very valuable niche user base.
And proven path to profitability. That's the new piece. And if FUBO were valued that way, as a tech asset, the analysis estimates the valuation should be, well, 2 to 3 times higher than it is today.
Which brings us right back to that $2.52 price. You called it the golden zone. Why that specific term? What's so golden about it?
It's the golden zone because the discount is just so extreme, so irrational. It all boils down to the price to sales ratio, or PS.
Okay.
Right now, the stock is trading at roughly 0.5 times its annual revenue.
Wait, 1.5x sales. So let me get this straight. For every single dollar in revenue FUBO brings in over a year, the entire company is only being valued at 50 cents.
That's the perfect way to put it. And the report makes this critical comparison. Stable tech companies with recurring subscription revenue, they typically trade at 3x to 5x sales.
Not 0.5x.
Not even close. The report is explicit. FUBO is trading with a PS ratio you'd see for a company that's actively in bankruptcy proceedings. And yet, they just prove they can be EBITDA positive.
The valuation is just completely disconnected from the reality on the ground. So let's quantify that upside for you, for the listener. If the market just corrects this one error, what does that do to the price?
The analysis suggests that if the stock just returns to a modest 1.0x sales valuation, which is still incredibly conservative for a business like this, the share price doubles instantly. It blows past the $5 mark.
But, waiting for the market to wake up and smell the coffee can take a long, long time. Is there a catalyst that could force this to happen faster?
There is, and that's what makes this so interesting. The analysis points to the short squeeze setup.
The shorts.
Yes. The short interest is really high, right around 18%. That means nearly 1 out of every 5 available shares has been borrowed and sold by traders who are betting on the company to fail, to go bankrupt.
They're trapped in that old cash burn narrative.
Completely trapped. But with 2 quarters of positive EBITDA, that bankruptcy thesis is, well, it's on life support. The analysis says the event to watch is the Q4 earnings report.
Which is their strongest season, right? With the NFL and NBA in full swing.
Historically, they're strongest. So if Q4 earnings come in strong or even just beat expectations, those shorts are suddenly in a world of trouble.
The story flips on them overnight.
Completely. They're forced to cover their positions to stop the bleeding. They have to buy back all those shares they sold. And that forced buying from 18% of the float acts like rocket fuel. It can create a massive rally all on its own.
So, okay, let's pull this all together. What does this mean for you? The core idea of this whole thesis is that the past performance, that depressing chart, is a terrible predictor of where the company is headed now.
Right. The new data, the positive EBITDA, the record loyalty, that absurd 0.5x PS ratio, it all suggests the turnaround isn't coming. It's already here.
The market looked at the past and saw a failed SPAC.
While the contrarian view sees a company that just proved it can be profitable, has this incredibly resilient customer base, and is trading at a bankruptcy price while holding hundreds of millions in cash.
So giving up on FUBO now at this price isn't just bearish, according to this analysis. It's a mistake. A mistake rooted in looking backward. And that raises a really important question for you to consider. In the investments you follow, are you examining the current financial pivots, the fundamental operational changes happening right now, or are you just reacting to the ghost of the historical price chart? Something to think about.